let's look at a couple of these real quick before we do the problem on the board, and then we'll come back if we do that and finish up the remaining slides, okay? What we did last week, remember, we looked at just kind of an overview of mergers and acquisitions, like, some basic terminology, what's an acquisition, what's a merger. I'll pretty much just say a merger and acquisition, I'll use those interchangeably, but we know they are actually different, right? An acquisition, a firm buys another firm. A merger, they combine together, right? They become a different firm. We looked at the different kinds of motivations, types of mergers, horizontal, vertical, etc. What are you trying to achieve in these? What are some other ways of looking at the motivations? Are they synergistic? Do they create extra value that wasn't there before the merger? Or are they financial? They don't do that at all, just another motivation. We'll do a synergistic merger on the board. That'll be the last problem that we do for the semester. And where was I? Here, right? So the process real quick. So merger and acquisition process, just like you're in a firm, you're in a, you've gone the corporate finance route after you graduate. Or you've gone the investment bank route, and so you're advising a company, a corporation has come to you about this. So some company has decided, we want to gain market share in our market to gain dominance in our market, right? Then they're gonna look at a horizontal merger, like Dunkin' buying Krispy Kreme, right? You're taking over part of the market, which presumably gives you more pricing power. On the flip side, it's going to put you under scrutiny from the federal government in terms of antitrust violation. They might go and reject your merger petition, if you will. So that would be the first step, is to simply, when you look at a target, you're trying to think of those different motivations. Is it someone in the same line of business, so we're trying to take over market share? Is it someone who is behind us in the supply chain or in front of us in the supply chain, so that's vertical? We're trying to take away their competitive advantage over us, right? Like supplier power or buyer power. We're trying to create barriers to entry by doing that. It might be a conglomerate merger, we're trying to reduce risk. So various things of that nature. Then you go and you value the target. And this becomes a bit different. You would value them as they are right now, but then you'd value them again in terms of what you think they're worth when you bring them on board. Like, can you create synergies with this firm? And if you can, they should be part of that value, right? So that's determining the value. So a bit different than we did back before we did the corporate valuation model. Now we have to think about what could change in the target firm or the bidding firm, the acquiring firm, as a result of doing an acquisition or a merger. And then they have to determine what kind of offer price, or you could say, what's the minimum we could offer, what's the max we could offer, and then where in that range should we offer to buy their firm, like how much should we pay? A bunch of this, in case you're thinking, sounds like negotiation stuff, right? Like maybe lawyers get together, or someone like that, and you would be exactly right. The method of payment, like I'm running the bidding firm, I'm acquiring your firm, you guys are the target, you're the shareholders in the target. So am I going to pay you cash for every share of stock you have? Basically, am I buying you out? If I do a cash offer, I'm going to pay you cash for your shares, you walk away, I now own your shares, I own your company, right? That's going to be a process there. I could do a stock offer. I'm going to create additional shares of stock in my company, not the shares that are already outstanding in the marketplace, but new shares. So I'm kind of diluting my ownership. I'm going to give those shares to you guys, and you're going to give me your shares. Now, and your shares, basically, I'm going to throw them in the fireplace. Don't need them anymore. Now you guys are part of the combined firm. I'm a part owner, and so are you. Right? So you don't walk away in this one. You've got some skin in the game, right? The cash offer, I bought you out, you walk away, you're on the beach for the rest of your life. The stock offer, it's, maybe the acquisition goes well, maybe it goes better than planned and the stock goes up in value. You come out a bigger winner. Maybe the acquisition didn't turn out so good and the stock plummets. You guys are hurt just like me, right? Since you have skin in the game. I could do bonds. I could go and pay you debt for your equity. It sounds odd. It doesn't happen that often. We're not going to look at a deal like that, but it could happen, right? So I could pay you bonds that I issue out of my firm in order to acquire your shares of stock. Just like any other financial transaction is all that is, right? The equity has a value, the bonds have a value, you make an exchange, so that should be able to work. There is a big section, I can't remember what pages it starts on in the chapter. We'll look in the chapter itself more about some pages to ignore when it comes time to study for the final. We'll do that on Thursday, right? I won't bring the textbook up today, but we'll do that on Thursday. There are a number of sections in this chapter I'll tell you guys just don't bother with. We're not covering them. Or just get the basic overview. They spend a good bit of time in the chapter looking at accounting treatments for mergers and acquisitions. It can be a fairly complex topic. If I don't have any none of you guys are accounting majors. None of you are you?
Yeah.
So you are. So you're made. Were you? Okay, so you had an accounting degree before. Rita?
I'm double major.
So you're double and minors? Okay, so I got two of you. Did you ever had advance? So you had advance, and that's where you had acquisition accounting. Okay, so that is in, there's the basic accounting, there's the intermediate accounting, then there's advanced, which has, I guess, the tax and the acquisitions and some specialized topics, right? That are a good bit more tricky to deal with than the basic stuff. And that's the problem, is when you start combining two firms, the accounting of how to add them together can be kind of tricky, and it has changed over time. But you get something you guys see in a lot of companies' balance sheets called goodwill. You have to be careful here. If you went up and took a marketing class, right, from the fourth floor, they might talk about goodwill being brand recognition. Guess what? That's not in the balance sheet. That should be reflected in your stock value, but you're not going to find that in your financial statements. The goodwill in your financial statements is one firm has basically, you could say, overpaid in buying another firm, right? The value of this firm that we just bought, the value of your firm, is $10 billion, but I gave you $12 billion. That $2 billion extra is probably representing the synergies that I've determined are there, but it may not be recognized from an accounting perspective, so I have to put it down as goodwill, and that's what that is. So you could say it's an overpayment from an accounting perspective. And then maybe the merger is welcomed by you guys. Remember, you're the target firm, right? I'm going to buy your firm. I'm the bidder. So maybe you welcome it. Maybe you realize, like, yeah, this guy is going to come in and offer us a massive premium for our stock, and we're going to be bought out, and we're going to go live the rest of our lives in luxury. So you say thumbs up. Maybe you do like a lot of firms, and you say every firm, the CEOs always say our stock is undervalued. They say it night and day. And when there's an acquisition attempt, they almost always say, you're undervaluing our stock, and you're insulting us as a result. Sometimes we do it to try to extract a higher price, to get the bidder to push up their bid. Sometimes they do it because they genuinely do not want to be taken over. Maybe they realize they've done a bad job, like, you guys are awful managers, and I'm going to boot you the minute that I take over the firm. Like, you don't want to go along with that. You don't want to lose your jobs. So that can end up in a hostile takeover. Or basically, instead of going to management and the board, which is a friendly takeover, I have to go in run directly to the shareholders who own the stock in your firm and get them to approve it by tendering or selling their shares directly to me, right? So we'll talk more about that in a bit, okay? Let's go through an example, then we'll come back and finish up the slides and look at some more aspects of this stuff. Okay, so I'm gonna do an acquisition where we're simply gonna say we got a bidding firm, that's the acquiring firm, and a target firm, the firm that's being bought, okay? I'm gonna use the two terms, merger and acquisition, interchangeably. And we'll assume it's a friendly acquisition. I don't think, it's not really gonna matter necessarily, but we'll just say it's a friendly acquisition. So let's put some basic data up here. Let's say, here's the bidding firm. We'll just call them B, bidder. And here's the target firm. Here's their equity value, all of their stock, right? So the total value of their equity. Let's say it's $50 billion for the bidder, and it's 26.25 billion for the target firm. N is going to be the number of shares of stock. Let's say 1 billion. And so that's going to give us our stock price. So $50 a share for the bidding stock, my stock's at $50 a share. You guys have 250 million, so be careful here. I'm changing scale, all right? $250 million or 250 million shares. That's going to give you a price of 105 per share. Your stock's actually trading at a higher price than mine, and I want to buy all your shares. That's not going to be an issue. Heck, your firm could be worth more than my firm. That still wouldn't necessarily be an issue. All right. So let's put a few other things over here. Bidder and the target. No debt. No preferred stock. No non-operating assets. We could add those three things in, but it just makes it a little bit, it just mucks it up some. It doesn't add anything to the analysis, it just makes it more realistic. So let's just make it two all equity firms, okay? They've got no debt, no preferred stock, no extra assets that are non-operating. They're just all equity. Okay, so I identified my target, right? Now I have to go value it. Now, I know what it's trading at in the market right now. It's trading at $26.25 billion, or 105 a share. But I want to value it with, in fact, let's do this real quick. Where do I want to put this? Let's put it here. Let's put up here first the offer range, like how little and how much, how little could I get away with? What's the lowest offer I can make to you guys that might possibly be accepted? Maybe. And what's the highest? Now you guys would take an unlimited amount, but what's the highest I likely would offer, right? So what's the min and the max? What's the range? So let's see. What is the min? I'd love to buy you guys stock for 0, but you're not likely to go for it. So what's the min? We don't even have to do any number crunching for this at all.
Just the stock price?
It's your current stock price. It's the 105, right? That's your stock price right now. So it's the target firm's current stock price. That's the min, okay? The max, in fact, let's just call this current stock price for the target firm, right? Current stock price for target. The max will be P0 for the target plus per share synergies. Okay, now we gotta do some number crunching. We gotta figure out how much your firm is worth with these possible synergies. What kind of value do they create, right? And then I know the maximum end of this thing. Okay, so let's do this. So here's the target firm. So here's where you guys are currently. You have free cash flow of $2 billion. you are growing that cash flow at 5% a year, and your cost of capital is 13%. So we take all that and put it together. And remember, you've got no debt, no preferred stock, no non-operating assets. So the value of operations, the value of the firm, equity are all the same, right? They're all going to be the same. So the value of your operations will be the value of the firm, will be the value of your equity, and that will be your free cash flow increased by your growth rate over your WACC less your growth rate. So 2 billion increased by 5% over 13 plus 5. That is going to be 26.25 billion. Exactly what I put over there. Your firm is fairly valued in the market right now. I want to do this first anyway. Your firm may be under or overvalued in the market, and I want to determine that. But right now it's trading in equilibrium. It's where it should be trading according to efficient market theory, right? It's trading at what it's worth. If I took that 26.25 divided by your 250 million shares, I'd get the 105 per share stock price. So I get that. Okay, let's look at, let's now include estimated synergies. Right, if we do this acquisition, what's going to happen? So let's say there's two things. Let's say we get an immediate boost in free cash flow to 2.2. In fact, let's do this. Here are the synergies. We have a reduction in taxes. Your taxes will go down. So your cash will go up. Less taxes, more cash flow. Okay? And your cost of capital will go down. I think we said back in the capital structure chapter that big firms, well, no, we actually said in this chapter that there's economies of scale, financial economies of scale, where large firms can access financial capital at lower cost than small firms. And that should mean the lower cost of capital for the large firm, all else equal. So your cost of capital goes down. So let's say the growth rate stays at 5%, but now lower cost of capital, 11% for that. Okay, here's what you guys are going to look like now. 2.2 billion growing at 5%. And then the denominator, 11 minus 5. So you guys now have a value of $38.5 billion. So here's what you're worth right now, but the synergies I think are available pushes you from this number to this number here, okay? So let's see. So this right here, I can take your value, that 38.5 billion, and divide by the number of shares of stock you have. That's 154. So your stock price, including those synergies basically are worth 49 bucks a share, is what we're saying, right? They've increased you from 105 to 154. All right, so the synergies here are 154 minus 105. They are $49 per share. Or you could say, I pushed your value up to 38.5 billion from the 26.25 billion. So that is 12.25 billion total. In other words, we should be able to increase our value together by $12.25 billion with this merger or acquisition. Now, if all of that increase went to you guys, the target shareholders, then that would mean me paying you $154 a share, right? So that's why that's the max. If I go over that, I'm paying you your current price plus the synergies per share plus extra. It sounds kind of dumb, right? It does happen, by the way. It happens a lot. But I wouldn't want to knowingly go over that price. So my range is 105 to 154. Where am I going to be in that range? This is where finance takes a back seat and its negotiating skills. Probably going to be the two companies' lawyers, right? Or maybe they hire on someone who does negotiation for a living, right? And there'll be a number of things that come into it. Basically, negotiation skills on both sides of the table. Am I the only company bidding for your company? I'm the only one who wants to buy you. Then I could probably get you closer to 105. But there's competition to buy you. There's other firms that might be interested in you. Then I'm going to have to offer you more so I get you instead of them. Or to keep those other firms from showing interest in the first place, I might have to offer you more. So a number of things: negotiating skill, competition to acquire the bidding or to acquire the target firm are all going to come into play on this. And that will tell me how close to here or how close to 154 we're going to be. Let's say that we're going to do a cash offer equal to 126 per share. Okay? We're going to do a cash offer here. That is basically a 20% premium. How'd I get that? 126 over your current 105. That's 1.2. I'm paying you your current price plus 20% more per share. Outside of negotiating skill, and other companies that might or might not be interested in you guys, anything else that comes into play, I might look at other transactions, other acquisitions, and see what premiums they tend to pay. That might be my starting point. I might find that over the past 5 years, the typical premium for companies in our industry has been a 20% acquisition premium. Okay, that's a pretty good starting point, right? And maybe from there, maybe you negotiate me up to a higher point. Maybe I have that value. Maybe I actually want to start you at a lower point than that in the negotiating process, but that might be, kind of my target in the middle, is looking at what prior transactions have gone at. So let's do this. So this is going to be cash. So I'm going to buy every one of your shares, 250 million shares, at a price of 126 a share, a 20% premium over what it's currently worth to you, okay? And once I bought you, you're out of the equation. You've got a pile of cash, I've got your company. It's mine, okay? So let's see here, we want to do two things. I want to know, out of the synergies, remember the synergies are $12.25 billion. I want to know how much of those synergies did you guys capture? That's the added value you get out of the acquisition. Like, how much did you benefit? How much did your wealth go up by the percent of the synergies you captured, right? You already know you're pretty well off. You could say, well, heck, I'm going to be better off by 20%, and that's going to be true. We could do it that way or some other ways. Your stock went from 105 to 126, $21 a share on 250 million shares, right? So we could estimate it several different ways here. So let's see. Gains to the target firm. Like, how much did you benefit from this? What was the increase in your wealth? And it's going to be the percent of the synergies that you've collected. So we could do it a couple ways. We could say you got 126 a share times a quarter of a billion shares, right? So the price there, your number of shares there, and that would be 31.5 billion. And you started with a company value of 26.25 billion. So that means that you came out ahead by, what is that, $5.25 billion. That's how much you benefited from it on this. That's one way. You could do it a different way. You could have said, our stock price went from 105 to 126. It went up 21 bucks a share. And it did that on a quarter of a billion shares. And that's gonna be 5.25 billion. Again, it doesn't matter which, so you got two different ways of doing this. They're gonna get to the same result, okay?
Where do you get the 0.25 billion again?
That's the number of shares. That's the number of shares, right? So I'm paying you guys 126 for each of these shares right here. That's how much cash you have. And you gave me your stock, which had been worth this right here, right? So you're actually coming away with 31.5 billion, but you're coming away with this much more wealth than you had before my acquisition. That's what we're doing. Now, what about me? What am I gaining as a bidder? Well, I am going to get, I've got two ways I could do this. I can do it kind of an easy way, or I can do it a difficult way. The easy way will work in this. It won't work when we do a stop. So I could say easy way, my total synergies are 12.25 billion. And what were the gains that you collected? You collected 5.25 billion. So we've got 7 billion left. Of the total synergistic gains, they have to go between you and I somehow. You got 5.25, I got the other 7. That's 12.25 total. That's one method. Here's the other method, and we're gonna have to use this other method when we do a stock offer, so let's just see. I want to take the value of equity in my firm here before we do anything, 50 billion. I'm acquiring your firm, the equity in the target firm, 26.25 billion. I'm also getting all the synergies, 12.25. So that is going to be a total of $88 billion of value right there. Then I'm going to put up here, what's the cost? How much did I pay you guys? I paid you 31.5 billion to buy you out, right? So I paid this amount right here. So minus 31.5, and that, we're gonna call that equity in the bidder. I'm gonna put an asterisk up here. That's after the dust is settled, right? I've gotten your stock, and what I've got here is $56.5 billion worth of value in this company. Like, I've got something wrong here. 38. That's 88.5. So that's 57. Right there. I'm going to divide by the number of shares of stock that I've got, that billion, And that's gonna give me a post-acquisition price of my stock of $57 per share. So I can tell my stock price should go up to $57 a share after I buy your firm for $126 cash per share. And that means I can go look at my second method of estimating how much I gain. I can say my stock went from 50 a share to 57 a share by changing the stock price. So that's my stock price of the bidder before anything happened, and that's the stock price in the bidder after the acquisition. We had 1 billion shares, and that's going to be $7 billion. So I got two different ways I can get that number. They're both going to agree with each other. It's obviously an easier method there between them, but we might need to do this stuff here at some point. Okay, so that's a cash offer. Now, let's go do a stock offer, okay? I'm gonna leave all this so we can compare it. Let's do a stock offer over here. I want to do a stock offer that's equivalent to $126 a share, right? I want to give you $126 of my stock for every share of your stock, okay? So, let's see, stock offer, $126 of the bidder's stock per share of Target's stock. That's what I'm going to do. So, in order to do that, I'm going to do this. Here's what I'm going to give you. I'm going to give you 126, and here's where my stock is right now. That's the price of my stock. And this is basically my offer here. So that comes out to 2.52. I'm going to give you 2.5 of my shares per each of your shares. So what I'm doing here is I'm not going to give you cash. I'm going to do a stock offer. I'm going to print up additional shares of my company stock, but I want them to be equivalent to a 20% offer that we did before, $126 a share. And that's how I can come up with this. So what I would have offered you in cash divided by my stock price before everything, 2.52 shares. If my stock had been higher than yours, I could have given you a fraction of my share for every one of yours instead, right? So let's see, that. Now, we're gonna have to go from this. That's the first step there. Second, we're gonna have to figure out what's my company stock price gonna be after this, after I give you shares of stock. So, let's see, I need the equity in my firm, your firm, and those synergies again. So what did we have? We had 50 billion, 26 and a quarter, 12 and a quarter. So there's the total. So again, that was the $88.5 billion. That's the exact same we had over there, okay? Here's where it gets a bit different though. The cost. How much am I paying you? Gotta be careful. The cost is an actual cash flow. I'm not paying you anything. I'm giving you stock. So here it's 0, right? So that means that the value in the firm after I've acquired yours is all of this. It's $88.5 billion. I didn't have to go and come up with $31.5 billion in cash. That sounds pretty good. But there's a downside. I'm gonna have a different number of shares here. So we gotta figure out this. What is this? This is gonna be the number of shares I started with. I've got 1 billion shares of stock in my company, okay? That's gonna be my number of shares. Plus however many shares I have to print in order to do this. How many more shares do I have to come up with? So this one here is going to be, I'm giving you 2.52 shares for each share of yours. And you've got 250 million shares. Right, so in 250 million shares at 2.52 shares per share, on 250 million, that's 0.63 billion. So after the acquisition, there's going to be 1.63 billion shares of stock outstanding. Let's dump that in here. I've got the original billion. I'm the founder of my company. I'm the only shareholder. I've got the billion shares. But the other 0.63 billion I created out of thin air, and I gave them to you, and you gave me your shares of stock in your company, and I threw them in the fireplace. They're gone. Now the combined company, we're all in it together. I own 1 billion shares in it, you own 0.63 billion shares in that combined company. Okay? Let's figure out what the stock price is after all this has happened. It's now going to be 54.29. There's a little bit of rounding error in this one, okay? The gains aren't going to come out precise like they did before, just because we're losing some precision doing this. So 54.29 a share. And you may say, well, that's not as good versus the 57 over there. Maybe. We'll see how things come out. Maybe the gains aren't the same here. Even though I'm still giving you 126 a share in value. Maybe the gains aren't the same. Okay, so there's second. Now I want to see who gains what, okay? So we want to look at the gains. So for you guys, here's what you're getting. You're getting 54.29 per share, and you're getting that on 0.63 billion shares. Right, remember that's what you have. You've got 0.63 billion shares at that value. And then your company was originally worth 26.25 billion. So you work that out, and you're going to get 7.95 billion. That's interesting. Instead of giving you 126 in cash, I gave you 126 of my company stock before the acquisition, and your gains just went up significantly from how much? From 5.25 billion here to almost 8 billion there. They went up quite a lot, okay? And then what happened to me? Well, I could say the easy way, if there are 12.25 of total synergies, and I gave you 7.95, then that's going to leave about 4.3 billion for me. And that comes out to 12.25. Alternatively, I could go and say the stock price is 54.29, and my stock was at 50 on 1 billion shares. I get 4.29 billion. That's just a rounding error. Don't make anything of those being different. If they were in a spreadsheet, they'd be exactly the same, right? They'd be precisely correct. So I want to summarize this. This may be the last bit of equation stuff I put on the board here for the entire semester. So we probably should have a drum roll or something right now. Let's see, what do I want to get rid of? Let's get rid of whatever we can up here. Okay, so let's see. Do this. Okay, so the offer, we did a cash offer, we did a stock offer. Well, we're looking at these, right? And the gains to the target under the cash offer were $5.25 billion. The gains to my firm, to me, were $7 billion. So the total was $12.25 billion. And then the post-acquisition or merger stock price was $57 a share. And over here, we got 7.95, 4.3, so that's 12.25 billion. And the stock price was 54.29 a share. I'm gonna let you guys write that down real quick. I gotta go get my phone so I can go and log back in on this computer. Just give me about 30 seconds while you guys are writing that down. Which offer should I use? You're taking my role now. Which offer, you're advising me, which offer should I use? Should I give you cash? Or should I do stock? Well, and you're consultants now instead of the target shareholders. The roles change. You're advising me, the bidding firm, right? So I want to give you. Okay, so you want me to give you cash so that my bidding gain is larger, right? And my post-acquisition stock price is higher. That sounds reasonable. I come out ahead if I give you guys cash in this. In fact, if I said I'm going to do a 30% premium, right? So we'll figure out the cash offer for 30% premium. How many shares under 30% premium? It's still going to do the same thing. It's still going to be more gain for me under the cash offer, but it's going to skew more towards you and the stock offer. It's always going to do that. So let's think about something real quick. It looks like I come out ahead here, so I have an incentive to do a cash offer. But there's a risk in this. What's the risk that I face?
They say
Let's say that you guys you're friendly, you want this, you want it bad, right? So what's the risk to me, the bidding firm, if I give you the cash offer versus the stock offer?
They say
Now remember, you're saying yes. You guys are salivating. You're ready. You want this money so bad you can't stand it.
Even if you're cash and then.
Well, let's say I've got cash. Cash isn't a worry, right? I can go raise whatever I need. The investment banks are salivating too.
It's a bad investment.
Yeah.
Like it doesn't give you the synergies.
Okay, that's it, right there. The synergies are estimated. And what if I've overestimated them? So instead of $12.25 billion of gains, what if they came out to be $250 million? You see what could happen? Does it hurt you? No. You've gotten cash, you've exited. So it doesn't matter if the synergies are realized or not. You guys have your money, you've exited the picture. I bear all the risk. Right? So whoever still owns the stock bears the risk in this deal. So there are the gains, but there's a risk side of it too. And since you guys exited, you got cash, I hold the stock, I bear all the risk. And the risk of the synergies not turning out as anticipated. And you could say, well, they could turn out seldom ever. Almost always they're overestimated because the executives and the board of directors are almost universally overzealous in thinking how much they can extract out of a target firm and how much value they can create. And quite often, they believe there's a synergy when it turns out there's none. And it turns out the synergies are actually negative because of cost of combining a firm eats up resources and it destroys value. I was working in a company before I ever came here, and they were consulting a bank up in Minnesota who had just acquired another bank because they thought there'd be a lot of synergies and it creates some value. And their accounting systems were so messed up. When they tried to merge them, they lost a bunch of their clients' accounts, like deposits disappeared, all kinds of stuff. They had to find a way to merge all this stuff back together and find everything. And by the time they got all that completed, it ate up all their estimated synergies and more. It completely destroyed value, right? So if the acquiring bank had done a cash offer, the target shareholders, the target bank shareholders, wouldn't have cared less, right? They've been on the beach somewhere and said, I could care less. That's all on you guys. But if they'd done the stock offer, then the target shareholders would be in it too, right? So you could say, the more confident I, the bidding firm, am that the synergies can be realized, the more likely I am going to do a cash offer and get you guys out of the picture. But the less certain I am about the synergies, like maybe I've overestimated them, things like that, the more likely I want to keep you in the picture as a shareholder so that if it doesn't pan out as expected, you're going to bear part of the cost with me. So I'm not going to bear all of the downside risk, you will as well. So the answer to that, well, it looks like it should be the cash offer because I get more benefits as the bidding firm. It depends on, in terms of risk, whether I think the synergies, am I highly confident? I'll do the cash offer. Do I feel they're highly uncertain? I'm more likely to do the stock offer and push risk over to you guys.
Do they ever mix them?
Yes, I could do $63 in cash and 1.26 shares of my stock for every share of yours. We could absolutely do that. It happens a lot. There are other factors too, like do I have cash to do it, or can I access the cash that I need? I may not have, what did I need to buy your firm out? 31.5 billion of the cash offer? I may not have 31.5 billion, so I might have to go borrow it or something like that. I might still issue more shares of my stock, but I raised the cash, then I gave it to you because I didn't want to go and give you any more of the synergies than possible. So I might do that. So there's any number of ways of doing this thing. But the big thing here is risk, right? And uncertainty about those synergies. Okay, so we are done with the math. Let's look some more at some closing items about the mergers and acquisitions. real quick, your textbook will have a big section, I don't know, it's about a dozen pages, where they look at 3 different approaches for valuing a target firm. They do the corporate valuation model that we've been doing, which is what I did over here to get the synergies. They do something called adjusted present value. We're not gonna do that, so don't worry about it. If you're curious, read through it, but I'm not gonna test you on it, you're not gonna see it in here. They do something else called free cash flow to equity. Basically adjust out the effects of debt, like how much cash will be left, how much free cash will be remaining to the shareholders after you took care of the creditors, free cash flow to equity, all right? It's a fairly simple concept. We're not gonna cover that, so don't worry about it. Again, if you're curious, it's in the chapter. Finance majors, it's worth knowing, especially if you get out inside. I wanna be an analyst, because you might see those, but I'm not gonna test you on it. You're not gonna see it in the homework. And they go into those in some detail with a pretty lengthy problem. Do companies that are acquiring others actually use those methods? Yeah, it turns out that one of the most popular ways of valuing a target firm, and you can't see that too well, I guess. Maybe I should never have highlighted that. But it's discounted cash flow techniques are one of the most popular ways of valuing a target firm. Corporate valuation model, adjusted present value, free cash flow to equity, right? So techniques like that, like we did here. The next one I've got highlighted, so it makes it almost impossible for you guys to read, is comparable transactions. What would that be? Instead of valuing your company at a per share price, I might say, right now, you're trading at a PE of 10 times earnings. But I've seen that the PE of most companies that have, of transactions, of acquisitions in the past 5 years, I've seen the average PE at 14. So how I could do this is the following. I could say that, let's see, right, you've got earnings per share of $10.50 a share. Is that gonna work out? And that gives you your stock price, 105, looks right. If you're trading, your stock's 105. If you have earnings per share of 10.50, your PE ratio is 10. Your stock price is at 10 times your earnings per share, okay? But what if I found, over the past 5 years, the average paid for an acquired company comes out to be a PE of 14. Remember, it's a premium. Most get bought at a premium. And so your earnings per share are 10.50. That means I should be paying you, what is that? 42. I should be paying you $147 a share and not $126 a share, because that's what the transactions have been like over the past several years, right? That's comparable transactions. And we'll simply say, what was the average PE for these companies that got bought? Let's apply that to this firm, multiply it by its earnings per share, and voila, we've got what their stock price would be, right? What we'd have to pay them. Sometimes they look at what's called impact on earnings. And most buying firms would like to see that their earnings per share goes up after the acquisition. And that's referred to as, it's a term that's not even in the chapter, but it's worth knowing because you hear it a lot in the merger acquisition universe. It's called accretion. Sounds like something you'd have to learn if you had a botany class, I guess. But accretion simply means that earnings per share goes up in the acquiring firm, the bidding firm, as a result of the acquisition. Now, why would that be important? Let's say that I went and bought you guys, let's say, let's go over here. let's say I've got earnings per share of 2. So I'm trading at a PE of 25, right? Price to earnings 25. And let's say that after the acquisition, earnings are expected to be accretive. They're expected to go up compared to where they are now. That is, when I add the two firms plus the synergies, earnings per share expected to go to $2.50 a share. Now you say, well, that would give you a lower PE. That's not how CEOs look at it. They say the following. They say that before the transaction, the PE was 25 and our earnings per share was 2. So there was our stock price, $50. And then after the acquisition, they would say the PE is still 25, but our earnings per share are $2.50. And so we are now worth $62.50 a share. We should gain $12.50 a share because this acquisition, because earnings are expected to be accretive. They're expected to go up per share. A lot of acquisitions are based on this notion of earnings per share going up. So it's called accretion versus dilution, or dilutive earnings, where we do the acquisition and earnings per share goes down. And that's the whole basis for it right there. You say, that sounds simple enough, but there's got to be a catch to this accretion dilution stuff. And what is it? It doesn't look at risk, right? I can drive earnings per share up, but I might be driving risk up more, so my stock price falls, or maybe my multiple falls. We find a lot of flawed stuff in finance. We find a lot of stuff being done correct. One of the flawed things is accretion or dilution that gets looked at a lot in these deals. So that's how a lot of these things get done in terms of valuing companies. Those are some of the main methods there. Determining the offer price. I'm not going to offer you less than your current stock price. In fact, you're not going to take that. You're going to want a premium. I'm not going to offer you more than your stock price plus the per share synergies, right? Because then I'm just blowing money by doing that. Somewhere in the middle. And then we also know that I can mix these things, right? Cash, stock, or some mix of them. Pay you cash if I'm certain about the synergies. I want to capture as much of it as I can. I do stock if I'm uncertain and it's risky buying you guys out. I want you to hold shares as well with me. In terms of the actual process, so I've identified you, I've valued you, I've come up with an offer range, I've submitted the offer to the CEO and the board of directors, actually to the board of directors in your firm. So I go to your board, I submit the offer, $126 a share cash, and you've got one of two things you're going to do. You might say, we've been waiting for that forever. You took for so long. Give us a check and let us go. Here's your shares, right? You bring the wheelbarrow full of your stock certificates out, and you take your cash and you go run for the beach, right? That's the friendly acquisition. The unfriendly or the hostile is where you say, 126 a share is an insult. Our stock is worth so much more than that. When, it's like, you're trading at 105. Yeah, but it was undervalued, and it's still undervalued at 126, right? So maybe you're simply trying to push for a higher offer price, or maybe you're simply trying to push me away altogether, okay? Maybe I up the offer and you still turn me down. So what could I do? Once I've gone to your board and they've turned this offer down, I could then go do an end run and go straight to the shareholders in the target firm, and I could say to them, your board turned this down, but I want to offer you guys $126 a share in cash, 20% premium over what you currently have. I'll give you, and we saw the Williams Act said I have to give you at least 20 days from the time I do an offer for you to tender your shares, and anyone and everyone that I made the offer to, like all the shareholders in the target firm, could tender their stock up. And I'm not gonna just take the first 51%. If every one of you offer your stock, I have to buy it all, right? I'm looking to get control. I want at least 51%. But if every single share is tendered up, fair enough, I'll do that. So I'm gonna give you a minimum of 20 days to tender your stock at that 126. What if not enough of you do? I may have to up it. I may have to go to 135 a share to get more shares tendered. So that's entirely possible, right? That's called, again, we had this term before, a tender offer, a premium for the stock price. But even then, it's gonna have to go to a vote in your company's shareholder meeting. You know the board's gonna want to turn it down, and they probably own stock as well. So they're voting their shares and they're giving thumbs down to the acquisition. But I want you guys to give it a thumbs up. So part of taking the offer means that you will vote yes for the acquisition to go through. And that's called a proxy fight. I want you basically to say, vote yes for the acquisition. Right, so that's the proxy fight there. So that not only do you accept the cash, you vote for the acquisition to go through when that's put to the board of directors. Blowout bid is something that happens a lot in acquisitions. If I think there's potential competition to buy you, then what could I do? I could lowball, and then that creates a problem. If I lowball to try to acquire your stock, I get you cheap, but it might signal to a sleepy bunch of competitors that weren't looking at you like, hey, there might be value here. Maybe we should be looking at buying this company. And they start doing the analysis and say, yeah, you know what? We think the synergies are 15 billion. We could offer you even more. And then it starts a bidding war, all because I was too cheap and I lowballed. So maybe I should do a higher offer, not all the value, but a higher offer to try to get you before any competition comes in to start competing in the process, to start trying to do competitive counter offers, right? I don't want that to happen. So I might do a larger offer up towards the max just to keep competition away, right? So you agree to it straight away. The M&A universe has a good bit of colorful language and terms. I just put a small sampling up here. So some defenses that companies erect in the event of a hostile takeover can be done after the takeover's been announced. Those are post-offer defenses. Others, if they're done after, could be challenged court, so they have to be in place before. Those are pre-offer defenses. Rights-based defenses, so a poison pill you hear a lot. So I'm the bidding firm. You guys are the target firm. If you have a poison pill in place, then a poison pill might be this. It might say that in the event of a hostile takeover, the existing shareholders, excluding whoever is trying to take your stock over, me, excluding me, have the right to buy additional shares of your stock at, say, 20% discount, some discount. Now, why would that help thwart a hostile takeover? Because it's going to put more shares of stock out there in your hands, and that's going to lower I've built up a 10% stake in your company acquiring stock. And I have to announce it. I have to file documents with the SEC. And you found out, and that triggered the poison pill. And that allowed you guys to go buy additional shares in your stock, the target shares, at this discounted price. Why not do that, right? You're getting it at a discount. But that increases your percentage ownership and reduces or dilutes my percentage ownership. And now I've got to buy even more shares just to get back to the 10% I was at, much less more. It makes it hard for a potential acquiring firm or individual to buy a target firm when there's a poison pill. because the number of shares is constantly getting larger. A poison put, you guys have a bunch of debt. It's not due for 10 years. You've got long-term bonds, nothing at all is due for 10 years. Pretty good. But the debt is structured so that in the event of a hostile takeover, that debt is immediately due. It has to be paid immediately. And it's a lot. Like, so if I buy your firm, I get the debt as well. And instead of being able to wait 10 years to pay off that debt, I've got to pay it the same day I buy your firm? Like, no thanks. So, so that's a poison put. Shark repellents are things that restrict, for example, someone coming in as a hostile takeover, someone trying to take over a firm. The corporate charter may say anyone or any entity that acquires more than, let's just say 40% stock in our firm. It's usually what, one share, one vote, right? But maybe once you go over 40% shares, I'm making that number up, by the way, your additional shares have no voting rights. Ooh, that's not good. I can't really take effective control of the company, right? The only way I can take control of the company is if I got 40% of the shares and then got you guys who are existing shareholders in the target firm to sign your proxies over and vote with me to favor the acquisition. I can't simply accumulate shares and be the controlling voice. So that's restricted voting rights. Golden parachutes would be where usually the executives and the board members get paid very lavish exit packages to leave the firm, and they get triggered in the event of a hostile takeover, and it hollows out the firm, right? A lot of their value gets taken out by the executives and the board members that are leaving. And then there's some other defenses that could be done after the takeover's been announced, like challenge it in court. What's the most common challenge? What do you think the most common challenge is in court? You should know this one, Travis. We've been seeing it several times in Roundtable. What's been happening in Noah's sector and in Dan's sector?
Oh, it's antitrust.
Antitrust violation. So the target shareholders say, yeah, buys us, you're going to create a monopoly or something that restricts competition in the industry. So you, Department of Justice, should go and challenge and stop this acquisition, right? Not because it's harmful to us, because we don't want it, but because it's harmful to the consumer. That's what they do. Leverage recapitalization. This one's interesting. You got, remember, target firm. You know I'm about to take your company over. You can't stop it. So you go borrow a ton of money. You take all that cash. Remember the Colt Industries little vignette that I put up? They borrowed a ton of cash and they did a one-time dividend payment. It plummeted their stock price to $10 a share from what it's 65. But that combined with the one-time cash payment was more than what the stock had been trading at before, right? Could you do that here? Could you borrow a ton of money and then take all the cash and pay it out to shareholders? So you're left with all the money you borrowed is gone. You're left with a ton of debt. So you've just made a highly risky firm for the bidding firm to take over, but none of what they borrowed is in the firm, right? You simply change the capital structure to a lot of debt and extract all that money out for dividend payment to the target shareholders. That's a leverage recapitalization. It's trying to make the firm look less tasteful, right, to an acquiring firm. Green mail is a process whereby I've been buying your shares. Like, I started at 105. I've been bidding you guys up to 126 a share. And I'm getting a pretty sizable block, and you want me to go away. And you guys actually have a bunch of cash. So you decide, we'd like to bribe you to give us back, you know, for me to give you back your shares. And you know, say, well, I paid 126. It's like, we'll give you 150 a share. like, you see what's happening here, you're paying me off fairly lavishly to give you the stock back so I don't take you over. That's gonna cost your shareholders a good bit, right? That's green mail. White knight, you could go find another suitor that you would like to have take you over. Instead of me, you just don't like me, so you find somebody else who would come in, be a shining white knight to take you over. Pac-Man, like I say, there's some interesting language in M&A universe. You know what that refers to, right? The video game from ages ago, right? So the round chomping heads. And was it like, you know, you could get chomped by another one that was bigger?
It was the ghost.
Yeah, so, you know, you're chomping stuff up and then this big one comes around and snaps you up. So this is where the bidding firm might end up being the acquired firm. And it usually happens because the bidding firm offers too little. And then instead of other firms out of the picture look and start analyzing the target firm and say, oh, we should make a bid for the target firm ourselves. The target firm analyzes the bidding firm and says, you know what, we should buy them instead of them buying us. Men's Warehouse and Joseph Bank, the two men's clothing firms. Joseph Bank made an offer for Men's Warehouse, this is years ago, and they lowballed like idiots. And Men's Warehouse looked at Joseph Bank and realized, yeah, there's some value there. We'll take them over. And they did exactly that. So the target became the bidder, and the bidder became the target in that one. I'm going to skip some of these here. Real quick. Disney stock gains after company loses bid to buy Sky Media. They were competing with Comcast to buy a British telecom firm called Sky Network or Sky Media. They lost the bid. Comcast stock plummeted and Disney's went up because they lost the bid. Here's what happens to bidders and to target firms after the announcement. So here's the announcement date of acquisitions. Here's the target firms. They gain a lot. Here's the bidding firms. They lose a little bit on average. They could see something going on here before the announcement date, which means that the information's leaked out some. But what it's telling us is that target shareholders tend to benefit at the expense of bidding shareholders. They capture almost all the gains. A couple other things. Most acquisitions take place at the peak of the market cycle when stock prices are the highest. So you're likely to overpay instead of at the bottom of the cycle. Most of the gains go to target shareholders. On average, bidders tend to come out neutral. About half do better, slightly better. About half underperform. The companies like Disney that fail in their acquisition attempts tend to outperform over the next 5 years the companies that were successful in their acquisition attempts. This came out of The Economist a while back. They did two indices. One was looking at the basic market, and this was looking at companies that acquired other companies, so successful bidders. And you can see the successful bidder index underperformed just the basic market index. Right, so there seems to be something where companies that acquire other companies tend to underperform. Let me go at this last slide and we'll be done with it. This came out of a McKinsey company study a while back. They collected a lot of data in their consulting. And they looked at what happens to company value, so stock prices, right, value of the firm, what happens to revenue. And they found pretty obvious, the quickest way to increase your revenue is via an acquisition. But the impact on value is almost entirely negative for the bidding firm. Making a new product, creating a new market, things like that, this is where competitive advantages come into play. That's how you create value, but it's harder to grow fast to do that. It's easy to grow fast with an acquisition. It's harder to grow fast by doing things internally with a competitive advantage. But that latter is where you create value. The former, the acquisition strategy, usually companies pay at or more than what the target's worth. And so the gains will go to the target shareholders instead of the bidding shareholders. Okay, that's it. So that's the last bit of knowledge for the training. We'll review on Thursday, okay?